All right, good afternoon, and welcome to the Tennessee State Funding Board for November 28th, 2022. Uh, First, I would like to say what we're doing here is reconvening the meeting from November 16th of 2022 to have our revenue estimation projections, among other things. I will note the presence of a physical quorum. And the first item on our agenda today is consideration for approval of minutes from the October 19th meeting. Members, I hope you took time to review those in your packet prior to being here. Any questions or comments, or do we have a motion and second to approve the minutes? Have a motion properly seconded to approve the minutes of the October 19th, 2022 meeting. All those in favor of approval say aye. Aye. Any opposed, like sign. The item is approved. Next on our agenda today is consideration and approval of staff recommendations of state revenue projections. In order to do that, we're going to ask David Thurman, the Division of Budget, the Budget Director, to be recognized.
Yes, thank you, Chairman. And so staff met last week and recommend to you for a growth rate taxes. A growth range of total taxes for FY23 of 6.82% to 7.27%. And for general fund, a growth range for FY23 range of 7.2% to 7.7%. For FY24, recommend to you a growth range for total taxes of 1.4% to 2.3%. And general fund taxes for FY24 growth range of 1.25% and 2.25%.
Thank you for that report. Members, so that we can have discussion on this item, do we have a motion? And a second? Have a motion, I'll second for the purposes of discussion. Members, how about any comments or questions? Commissioner, you're recognized.
I'll get here again. Okay. Dr. Thurman, thank you for this. Just one quick question. We've been through some very unusual, actually I have two questions, been through some very unusual years recently. If you go back previous to the last 2 or 3 years, what was our annual expected growth rate?
So we got to look back to think about several years to think about a normal growth year, because the last few have been kind of unusual. But I think 3.5 to 4.5%.
Was typically what we would have normally expected prior to the pandemic.
That's right.
The other question was, in your discussions with economists and those people, can you give us just a sense of what you anticipate the next couple of years looking like economically, just a qualitative assessment of what you've heard?
Yes. So again, just focusing on what the forecasters presented to us last week, we heard several things that kind of resonated with us. One, the funding board said they were going to continue to pursue the goal of reducing inflation. May accelerate or anticipate an economic downturn in 23, probably at the end of 23. They really weren't clear as far as timing and impact magnitude. So we talk about this every year, at least the last 3 years. The word uncertainty kind of resonated through all the different forecasts as far as when that would occur in magnitude. But expect slower growth going forward. I think right now we're at a period of unprecedented growth for sales and really F&E, total taxes. But what we heard is that would be a slower growth going forward. Again, not knowing timing and magnitude, but expecting inflation to ease in 23 at some point.
Thank you very much. And as we're here today, and members, as I was preparing today, I know like many of you spend a little time looking at the phone. I see headlines today like the economy may be the biggest bubble in world history. Another article, a collapse in home prices coming, experts say. Right over here, we have Horton professor says the U.S. economy is faltering. You know, in Tennessee, for the third year in a row, we're recognized as the most fiscally stable state in the nation. That is not something that just happened. That's something that has been achieved through diligence and discipline and conservative financial management. I believe, like the economists predicted, there is a slowdown coming in the economy, probably sooner than the end of next calendar year. And I see no reason for us to deviate from the path that has gotten us to be one of the 13 AAA states in the nation. Again, the state that carries the banner of most fiscally stable in the long term. And so I think the projections we have before us are very responsible. In the same way that we have done over the past couple years, we're adjusting for the current year as we have seen revenues come in. We are projecting conservatively for the out year. And, you know, when we're back here this time next year, depending on what we see revenues do, we can adjust again. So I think this is very responsible and a good way to go. Any further questions or comments? If not, all those in favor of the revenue projections as described by Director Thurman, respond by saying aye. Aye. Any opposed, like sign. The projections are approved. Next on the agenda today, we have consideration and approval of staff recommendations for lottery revenue projections. Again, Director of Budget David Thurman, you're recognized.
We had two presenters and staff reviewed those presentations last week and present to you a recommendation growth range for FY23 of 0 to 2% because one of the forecasters forecasted a negative growth rate. For FY24, also 0 to 2%. And then for FY25, FY26, and 27, a growth rate for each year between 1 and 2%.
Thank you very much. Members, do we have a motion and a second for the purpose of discussion? We have a motion properly seconded for the purposes of discussion. Are there any questions or comments on the lottery projections? Other than I always say, it's always a gamble. Members, with no questions, all those in favor of the lottery revenue projections, please respond by saying aye. Aye. Any opposed, like sign. The item is approved. Thank you very much. Next up, we have a report from the Department of Economic and Community Development for approval of funding for 3 fast track projects. Who is going to come down? Commissioner McWhorter, Mr. Vandermeer? Come on down. You are recognized. And members, unless there's any objection, I'm sure Mr. Vandermeer will have a report from you, I think. And then, Commissioner, we will consider all 3 projects at once. You're recognized.
Good afternoon, Mr. Chair and members of the board. I'd like to present the financial report. As of last meeting, our balance was $264.9 million. Against that, we've had obligated funds of $10.2 million. We also are requesting approval for transfer of funds from Fast Track to our Community and Rural Development Allotment Code in the amount of $4,220,000. What that is, it's related to the project that we brought to you back in about a year ago, last December 20th. Sonova Silicon is a company that committed to provide 140 jobs, $150 million of investment in Lake County. Lake County is the most distressed county in Tennessee. As part of that project, we have to provide rail service that will support that project and also to the port of Gates Landing up there. The estimated cost of that project is $14,420,000. What we did in the department, and Brooksy Carlton, who is here, submitted a grant to the U.S. Department of Transportation and was able to get $10 million to offset the cost of that. Because of all the federal requirements that are required in that type of contract, asking to be able to move this amount of fast track funds, which is basically the matching amount to complete that rail project, over to community and rural development, where we have written contracts that have all those federal requirements out of it, which are a lot different than our standard fast track contracts. Any questions about that?
Members, any questions? Thank you. If not, Commissioner, you're recognized.
Go ahead and read the other figures here. Fast track grants approved greater than 750,000 is 7.5 million. Grants less than 750 is 1,700,000. And fast track administration costs of $131.5 thousand. That leaves us with an adjusted balance of 261.6 million, against which we have 198.3 million of commitments. Leaves us with an uncommitted fast track balance of 63.4 million, which is 75.8% committed. The 3 projects today that are being presented are $45,862,810, and that would leave us with an uncommitted fast track balance of $17,524,540.63. Represents 93.3% committed.
Very good. Commissioner, you're recognized.
Chairman, to the board, it's good to see you all. Hope you all had we have 3 projects to describe today by Vandermeer. The first is LG Chem America Advanced Materials, Clarksville, Montgomery County. LG Chem is a leading chemical and science-oriented company focused on moving toward a more sustainable future. The Clarksville facility will be the largest of its kind in the U.S. and is expected to produce roughly 120,000 tons of cathode material annually by 2027, which is enough to power batteries in 1.2 million electric vehicles. Current plan is for the state-of-the-art facility to be constructed on the 420-acre site, Allensworth site, you may be familiar with in Clarksville. Construction is slated to begin in the first quarter of 2023, and the plant is scheduled to be in production by the second half of 2025. Once operational, the facility will produce cathode materials, which are one of the most critical ingredients for manufacturing of electric vehicle batteries. LG Chem America Advanced Materials is committed to create 860 net new jobs and make a just over $3.2 billion capital investment within 8 years. The company will have an average hourly wage of $33.42, which compares to the county median wage of $16.90 an hour. Fast Track Economic Development Grant funds will help offset expenses such as new building construction for a total of $40 million. The second project is Gold Creek Foods, LLC, Caryville and Campbell County. Founded in 2000 and headquartered in Gainesville, Georgia, Gold Creek Foods is one of the nation's largest full-service chicken processors. Gold Creek Foods acquired the assets of Campos Foods, LLC, which shut down its beef processing operations earlier this year. Following the acquisition of 241 Elkins Road, the Tennessee plant will be updated and converted into a poultry processing facility. Gold Creek Foods LLC has committed to create 218 net new jobs and make a $15 million capital investment within 5 years. The company will have an average hourly wage of $17.31 for new positions, which compares to the county median wage of $16.14. Fast Track Economic Development Grant funds will help offset expenses such as building retrofit, expansion, improvements, and acquisition of real property for a total of $1,862,810. Third project is Landmark Recovery Management Company, LLC in Franklin, Williamson County. Founded in 2016, Landmark Recovery is an addiction recovery company that provides individualized treatment for patients dealing with substance abuse. Approximately 1 year after they relocated its corporate headquarters from Arizona to Tennessee, Landmark Recovery is expanding their footprint to allow Landmark the opportunity to better serve the growing number of treatment facilities the company owns and operates across the U.S., including Landmark's newly opened treatment center in Knoxville. Landmark Recovery Management Company, LLC, has committed to create 1,300 net new jobs and make a $7.5 million capital investment within 5 years. The company will have an average hourly wage of $42.38 for these new positions compared to the county median wage of $21.53 an hour. Fast Track Job Training Assistance Program funds will be used to train the net new full-time employees for a total of $4 million. That completes my 3 projects descriptions.
Thank you very much. Very exciting. I think the first one you mentioned, largest foreign direct investment in the history of Tennessee. Congratulations on that. Commissioner, a couple quick questions. For the projects you described, have the companies that signed the incentive acceptance forms, do they fully understand those agreements? Have the checklist been completed for each project? And do all the projects you mentioned include accountability agreements which provide protections to the state in the event the entities cannot fulfill their end of the deal? Yes, thank you. Members, do we have a motion? Do we have a second? Any further discussion or questions? Have a motion in regard to all 3, properly seconded. Any further questions or discussions? If not, all those in favor say aye. Aye. Any opposed, like sign. The items are approved. Thank you all very much. Members, next on the agenda today, we have received a letter from the Tennessee Education Lottery Corporation notifying this board that the TELC has determined that an amount that maximizes net lottery proceeds to the state of Tennessee Lottery for Education account is less than 35% of lottery proceeds for fiscal year 2020-2023. The amount currently projected for the fiscal year ranges from $473 million to $483 million. That letter, of course, is in your packet, and this notification is made in accordance with TCA 451-111A3. Any questions? If not, we acknowledge the receipt of that letter. Next on the agenda, we have a report from the Tennessee Central Economic Authority. Charlie Lyons and Kelsey Dansby. You're all here. Come on down. Welcome, and you are recognized.
There. I'm Charlie Lyons with Tennessee Central Economic Development Authority. We cover the 5 counties northeast of Nashville. You have our financial information, and we are here to answer any questions. Currently, our revenues are running higher than our projections on both our capital and our general fund. We have 2 different budgets. What Kelsey just dropped off for you really is not a financial report. I am a big believer in activities versus results, and my staff gets tired of hearing that, but these are results, and I'd just like for you to be able to see some results of what this meeting entails as far as people with jobs, as far as roads, as far as development. Primarily, we serve Trousdale, Macon, and Smith. We do work with the organizations in Wilson and Sumner County, but please sort of keep that separate because they have their own organizations and we try not to confuse that. So any questions on our budget? Again, we are ahead on revenues, and at this point in expenditures, percentage wise, we're all in line with the time of the year.
Thank you. Members, I hope you had an opportunity to review the information in the packet prior to and review this results sheet now. Any questions or comments? If not, we thank you all for being here and acknowledge receipt of your report. Thank you very much.
You have a great Christmas if we don't see you.
You too. Next on the agenda, we have a report on the State Pooled Investment Fund and Intermediate Term Investment Fund. Marcus Clark, Thomas Kim, Kevin Gentry, come on down. You are recognized.
Good afternoon, members of the board. My name is Thomas Kim, Deputy Chief Investment Officer at Tennessee Treasury Investment Division. Today, we're going to report on State Pooled Investment Fund and Intermediate Term Investment Fund. In the past, the cash management was done in operations group. Now we have separated the functions. The actual managing cash, and then also reporting and performance on the operations side. With me, I have Marcus Clark, who is the Director of Fixed Income. He actually manages our SPIF and ITIF. And right next to Marcus, Kevin Gentry, he's a Director of Investment Operations, who's in charge of performance and reporting. So I'm going to hand it over to Kevin first to go over some of the overviews of SPIF and ITIF.
Thank you, Mr. Kim. Good afternoon, Chair and board members. Just wanted to briefly provide a little bit of background on the State Pooled Investment Fund. The investment objective of the State Pooled Investment Fund is to obtain the highest available return on investments consistent with the preservation of principal while maintaining sufficient liquidity for the state expenditures and other withdrawals from the pool. State Pooled Investment Fund. The SPIF includes both state funds and those invested in the local government investment pool. The SPIF is managed, like Mr. Kim said, in accordance with policy by the Treasury Fixed Income Team with assistance from investment operations. Next, the Intermediate Term Investment Fund is intended to be a longer-term investment option for funds and as an alternative to the State Pooled Investment Fund. The ITIF is authorized to receive and invest any money in the custody of any department or agency of the state from any county trustee that has been authorized by resolution adopted by the county legislative body or from any other participant in the State Pooled Investment Fund. The ITIF is also managed in accordance with policy by the Treasury Fixed Income Team, assistance from investment operations. With that, I'd like to pass it over to Mr. Marcus Clark, who will discuss our annual investment activity performance over the last fiscal year.
Thank you, Kevin. Good afternoon, members of the board. So, I'm here to hit on the most important points of the annual reports for both the State Pooled Investment Fund, the SPIF, and the Intermediate Term Fund, the ITIF. I'm not going to go like line by line or page by page, but really just focus on the most important things and provide some additional context with year-over-year changes that may not be apparent by just looking at this year's report. I'll start with some comments on the incredible change in Fed policy that we've seen starting late in the fiscal year. But I mean, it has been an incredible change, and I would like to spend some time on just talking about what's going on there. Then I'll get into the specifics of the fund. For the SPIF first, I'll talk about the change in size over the year. I'll talk about the change in composition and allocation. Then I'll go over the duration and liquidity of the fund. Then I'll conclude just with hitting those same points for the ITIF. But let me begin with just talking about the incredible change in Fed policy, because when we entered the prior fiscal year, 2022, the consumer inflation rate as measured by the CPI was around 5.4%. It was decently above the target that the Fed has set for itself of about 2%, but the Fed kept its Fed funds rate at 0, because in their estimate, the higher level of inflation would be transitory, primarily due to lingering effects due to the COVID epidemic that impacted global supply chains and just the global labor markets. Over the next 8 months, roughly about until February, inflation turned out to be a little less transitory, so it slowly kept inching higher. You could see that the expectations in financial markets kept building. So at the beginning of the fiscal year, the markets actually expected interest rates to be hiked once in about 2 weeks from today. So 1.5 years ago, the first hike was expected to be roughly this December, 25 basis points, one hike. By February this year, this expectation has been building to about 3 hikes also for the year. So by the end of this year would be at 75 basis points. Then 2 things happened that just changed everything in a very short amount of time. So obviously we've had the invasion of Ukraine by Russia. That changed all the expectations around commodities markets, energy markets, agricultural markets. And then very short thereafter, we also learned how committed China was to stick to their zero COVID policy by being willing to shut down Shanghai for months, wreaking havoc once again on supply chains and driving home the point that these seemingly one-time effects that the Fed was counting on may be here to stay. So that has changed everything. The Fed immediately went to town, declared war on inflation, and kept hiking and hiking and hiking. At this point in time, we are at 400 basis points Fed funds. In about 2 weeks, it is expected that we get another 50 bip hike. So we are at that point, we'll be 18 times higher than what was originally expected at the beginning of the previous fiscal year. And it is currently the market's expectation that the Fed funds rate will peak roughly around between March and June next year at around 5% or a little over 5%. But even today, we had a couple of Fed speakers on tape trying to out-hawk each other and preparing the market that they may not be done even if we get to 5%. They may have to keep pushing it a little bit. So yeah, we will see what happens there. But obviously, the good news is for the SPIF, the Fed policy, that sets the return for the most part in the SPIF. We've seen a lot of hikes, so which brings me to the question: how did the return look like for the prior fiscal year? Going back to the year before that, just as a comparison, that was a year where the Fed funds rate was at 0% pretty much all year. And the return for the SPIF in that year was 8 basis points, which was 2 basis points above our Treasury bill target. It's the 30-day Treasury bill. This year, which for 9 months still reflected the 0% Fed funds rate, our total return for the SPIF was 21 basis points, which sounds low. I just said that the Fed really went on a hiking spree, but that happened very late in the fiscal year. So we were not able to really take advantage of that until the second quarter. So yeah, 21 basis points, 2 basis points above our target, above benchmark. I expect it will look quite different when we meet again next year. Next, I would like to talk a little bit about size, because the SPIF has grown a lot over the previous year. We started the year with a size of about 20.5 billion. And there's in the annual report on page 4, at the top, there is a chart that shows you the average size, but I'm going to talk about the beginning and the end size. So we started around 20.5 billion. We ended around 29 billion, which was an enormous increase for the SPIF of over 8 billion in size. Now, 3.9 billion, so roughly half of that increase, has been due to the stimulus funds that are currently being parked in the SPIF until they are being redeployed for projects over the next 2 years. But over half of that growth has been organic. It hasn't been from our LGIP participants because their allocation on average actually has slightly declined from about 4.5 billion at the beginning of the fiscal year to 4.3 billion, which is just a small decline. It isn't from any growth in restricted funds. That has been stayed constant over the year at about 3.25 billion. So yeah, that has been quite sizable organic growth. So now the question is, how has this balance been invested? So there is a chart on page 3 that shows you the average allocation during the year, but I would like to hit on the changes to the prior year. The most important changes here is that we moved about 4% out of the most liquid portion, which is Treasury and agency, and moved all of that and then some more into commercial paper, kind of taking advantage of the really strong economy. And also the inflow of assets that makes the focus on liquidity a little less important. But other than that, the banks are still finding themselves flush with cash flow. The demand to borrow from the SPIF has been reduced. So the allocation to bank CDs has fallen on average from about slightly below 2% to 0.69% by year's end. This has since then ticked a little higher. I just hit on the point that we reduced the liquidity a little bit by moving out of treasuries and agencies. So this brings me to the next point, on the last point on the SPIF that I'd like to stress today, the duration and liquidity of the fund. So we have two measurements of duration. We have the weighted average maturity measured in days. We have the weighted average life, also measured in days. The weighted average maturity has been largely stable throughout the fiscal year. We've been in a range of around 40 to 50 days all year. Our stated maximum, according to our GASB 79 guidelines, is 60 days. So we've been decently below that target. We consider the 40 to 50 day range the sweet spot right now, where you have a good trade-off of yield and still decent liquidity. The weighted average life, the only difference between the weighted average life and the weighted average maturity is just the treatment for floaters. As the allocation to floaters in the portfolio has been declining, the weighted average life is slowly creeping towards the weighted average maturity. The weighted average life has a maximum of 120 days. We have been firmly below that maximum. I think we started the year at 57 days. At the end, we were at 50 days, and this keeps coming down as right now we are not buying any floaters. So that portion of the portfolio is slowly rolling off. We also have two measurements of liquidity in the fund directly. Of course, there's an interplay between duration and liquidity. The shorter your duration, the more liquidity you have. But we have two direct measurements of liquidity. We have our daily liquidity and weekly liquidity. And GASB 79 once again gives you two different guidelines. You have to have at least 10% of daily liquidity and at least 30% of weekly liquidity. And we have been all year firmly above both minimum guidelines. We have had at least 30% daily liquidity, which is 3 times the minimum. And we've had almost all year at least twice the weekly liquidity minimum, 30%. And that concludes my remarks about the SPIF. So I'll quickly cover the ITIF, which is, as Kevin mentioned, is an alternative that was set up in 2013 to the SPIF. It pretty much covers the exact same asset sectors of the market, so there is no difference in credit quality or anything that's allowed. The only difference is that you can go further out the curve. You can go out up to 3 years in duration. So that's quite a difference to our SPIF, that we can only go 60 days out on average. You can go 3 years out. So obviously, with this kind of duration, you are more impacted by the rise in interest rates during the year. So the total return is quite a bit lower for the fiscal year than in the SPIF. We've had a duration of during the year of roughly about 2.7 years at the beginning to 2 years towards the end. And the total return has been 329 basis points negative, so 3.29% negative. A suitable benchmark is the Vanguard, I think, short-term federal funds or federal portfolio that actually has performed worse than we have and we beat that benchmark by about 108 basis points for the year. The asset allocation has been stable throughout the year. We had about 56% in agency securities and 44% in treasuries. So that hasn't changed. Also, there has been no inflows or outflows all year in this fund. And with this, I conclude my remarks, and I'm happy to answer any questions.
Thank you very much for the report. Members, any questions or comments? If not, thank you again. Excellent and appreciated. The report is acknowledged. Now, members, next item on the agenda is consideration for approval of an amendment to the financial advisor contract with PFM Financial Advisors. Sandy Thompson, you're recognized.
Thank you, Mr. Chair. In your packet, you have a final version of the amendment to the financial advisory contract with PFM Financial Advisors. This will expire on December 31st of this year. And we are looking at extending that contract for one additional year from January 1st, 2023 to December 31st, 2023. The initial 3-year contract did allow for 2 one-year extensions. And we want to make sure that everyone's aware the services that PFM has provided are essential and important to the success of the issuing authority. And they've provided excellent service to the board and its staff. Therefore, staff's recommendation to the board is to approve the amendment to extend the term of the contract for 1 year.
Thank you very much. We have a motion to approve. I will second. So we have a motion properly seconded. Any questions or comments? So noted. All those in favor of approving the item say aye. Aye. Any opposed, like sign. The item is approved. Next on the agenda today, we have consideration and approval of other post-employment benefit trust for the town of Farragut. Now, Sandy Thompson, you're recognized on that item.
Thank you, Mr. Chair. In the essence of time here, I'm going to be brief on this one. That pursuant to state law, state and local government entities are authorized to establish OPEB trusts. And in order to establish those, they have to put them before the State Funding Board for approval. And this particular OPEB trust from the town of Farragut came before us, and we had the AG's office review it, all the requirements, and it has met all the requirements, and therefore staff makes a recommendation to approve.
Second.
Thank you very much. We have a motion. We have a second. Do we have any questions or comments? If not, all those in favor of approval of this OPEB trust respond by saying aye. Aye. Any opposed, like sign. The item is approved. Next on our agenda, final on our agenda today, is consideration of the request for approval to include certain indebtedness in the blanket exemption of current balloon indebtedness guidelines. Sheila Reed, Director of the Division of Local Government Finance, you're recognized.
Good afternoon, Mr. Chair. I am the director with the Division of Local Government Finance, and our office is responsible for approving requests to issue balloon indebtedness by local governments. And what you have in your packet today are 3 items: a request from our division, an executive summary, as well as a proposed update to State Funding Board guidelines. First, I'd like to share that we are requesting exemption from our approval for loan programs with the U.S. Environmental Protection Agency, as well as the State Revolving Loan Fund Program. And I'd like to share why this makes sense. In your package, you'll see that there's an executive summary. If you move down to the section on the summary, in 2014, the balloon debt law was passed, also known as the Anti-Kicking the Can Act. And when it was written, it was specifically excluded loans from the U.S. Department of Agriculture and the U.S. Department of Housing and Urban Development. And as a matter of public policy, state law does not prohibit local governments from taking advantage of normally low interest federal loan programs. In that same year, in 2014, EPA's Water Infrastructure Finance and Innovation Act, the WIFIA, was enacted. At that time, had we known that this program would gear up several years later, we would have excluded this federal loan program as well in our initial balloon debt legislation. We recently became aware that the terms of some of these EPA WIFIA loans have amortization structures that meet the definition of balloon indebtedness. The example that we have currently is for the city of Chattanooga, and I know you're familiar with their program and their consent decree from EPA to do multiple, a lot of investment to create their infrastructure for the water and sewer department. We received a call last week from their bond counsel, and when they were reviewing all of their closing documents, they discovered that the structure for repayment for the WFIA loan is balloon indebtedness. And so currently state law requires our approval of that balloon indebtedness, but because of the timing and at the stage that this loan is at, our office is not able to give approval. But in light of the fact that it is a federal loan program and that we would like to exclude it, in 2024, we do have plans to update the balloon statute for this change. But in the interim, we do feel like it's important to go ahead and revise the guidelines of the State Funding Board to exempt federal loans from the EPA, as well as the state funding, the state revolving loan fund for clean water and drinking water. And that is something also that was recently changed in the last several years. In the past, the term did not extend beyond 30 years, but now it can extend up to 40 years.
Thank you, Sheila, for that description. Members, any questions, comments, or do we have a motion to approve this change? Have a motion properly seconded. Any discussion? All those in favor of the change as described, please respond by saying aye. Aye. Any opposed, like sign. Thank you, Sheila. Members, the other next item on our agenda is consideration of motion to adjourn. Have a motion properly seconded for adjournment, non-debatable. All those in favor of adjournment, please respond by saying aye. Aye. We are adjourned. Thank you very much.